Hey everybody, welcome back to The Market Interest, where we talk stocks, finance, and the markets. In this video, I'm going to give you my thesis of a stock that I think is primed for the reopening of the economy post-COVID. This company's already had massive gains already, but if you can stomach some volatility, the fundamentals look attractive for investors seeking alpha within the next 1 to 2 years. If you want to stay on top of cutting-edge investment ideas and learn about what stocks could pop next, hit the subscribe button so you don't miss out on any of those opportunities. And if you get any value out of this video, go long on the like button. Now that we're at the tail end of the pandemic, we know people are getting back to their almost norm. They want to go out, they want to buy things. They feel like they've been trapped for 2 years, and now they want to go out and experience normal life, or close enough to it. And if you have kids and have been trapped in the house for 2 years with them as well, you definitely want to get out of the house, even if it's for an hour or two. So as I've been reviewing different stocks, that's when I came across Build-A-Bear. Now stay with me because you're not going to believe their performance in the last year. In 2021, Build-A-Bear was up over 300%, which is insane. That's crazy. I didn't even know that they were still in business anymore, let alone a public company. And analysts are now thinking that there could still be room for this company to grow, just based on their fundamentals. So let's dive into the details of this company and see where this stock can go from here. Build-A-Bear Workshop primarily operates specialty stores that provide make-your-own stuffed animals. It's an experience company, something fun for the whole family that doesn't require being trapped there all day, which is important for a lot of parents. Build-A-Bear has 3 segments: direct-to-consumer segment, commercial segment, and international franchising segment. The commercial segment is mainly consisting of licensing agreements, which I think is a very attractive opportunity for this company. And their margins within this area are really on point. All right, let's dive into the numbers now. All right, highlighted in yellow here, you will see Build-A-Bear. And if we take a peek at their market cap, it's $302 million. So it is definitely a small cap company. Really, you should expect some volatility out of this. Generally, smaller cap companies are going to have bigger fluctuations within their market price. So it's something to be aware of. And as you can tell here, underneath the beta, what's red here, that it's got a beta of over 2. So we know for a fact that this company is going to be very sensitive to what's happening in the market, over 2 times as much as what's going on in the general market. So if the market is up, let's say 10%, we should expect that Build-A-Bear would be up somewhere around 20%. If the market is down 10%, well, we would know that this stock is probably getting the stuffing knocked out of it, and it would be down about 20%. And clearly with those factors right there, those risk factors alone, this stock wouldn't be appropriate for everybody. It's going to be more appropriate for people who are allocating a smaller portion of their portfolio to invest in this over the longer term, or people who can really stomach some volatility. This isn't going to be a stock where you can cuddle up to nice and sweet every single night, but it's something where if we can be strategic about it and plan for this over the longer term, then it could be appropriate. Even after the massive 300+% gain last year, the stock price is only at $19 per share, as we can see right here, which I think is nice. It's a cheaper stock to get into. Its 52-week high was $24, and that means it's about 25% off of the highs, which that part I like. What I don't love is that it's still 78% off of its lows. So unfortunately, we're not buying it at the bottom, but nobody has that crystal ball. When we look at the PE, their price to earnings, it's only at 9, which I think is pretty fair. Actually, if we take a peek at JP Morgan's Guide to the Markets, the 25-year average is usually about 16 or 17. So for Build-A-Bear to have a multiple of 9, I still think that that's fairly low. All right, let's dive a little bit further into the numbers here. And we can see with the options market, there's a larger call value versus put value. The options market looks pretty positive. Let's dive into their revenues a little bit. Look at some of the history here. All right, so as you can see, it's pretty volatile. The orange line here is the change in revenue, and the blue line in the background is the actual revenue that they have experienced. As you can see, there's some fluctuations to it. And it looks like there's a little bit of a pattern, at least in terms of their revenue. It looks like this could be a seasonal company probably, the holidays or Valentine's Day. Yeah, usually in December, there's a big spike up every single year. So that would make sense. It being a little bit more seasonal, people buying gifts or going into the locations and having the experience for the holidays. The volatility in the orange line, obviously, that helps explain the volatility in the price movements. So it's something to be aware of as we're investing, or if you're investing, that you can go on a little bit of a roller coaster with this one. Their gross margin seems to be pretty consistent over the long term. Obviously, 2020, it was down. Usually, it stays pretty consistent within like the mid 40s. In 2021, their gross margin has boosted up somewhere into the 50s now. So we're looking at 52, 53% gross margin. That's extremely helpful. Investors like to see that. Let's jump over to Seeking Alpha and get some of their profitability measures. It has a handful more metrics on here. Free cash flow margin, not bad, especially compared to the peers, it looks like. That's good. Return on common equity, that's solid, 45%. The asset turnover looks like they are moving their product. Doesn't look as stable. This is over a 5-year period, so it doesn't look as stable as I would like. Obviously, in 2020 and 2021, that makes sense. They're clearly making a recovery, if I can get out of the way here. Clearly making a difference, starting to recoup that. But the fact that there's somewhat of a decline over time, just something to be aware of. You have to see where they're making up for that. So they have some pretty solid grades here in terms of their profitability. I wouldn't be as much concerned about their CapEx, just because it seems like most of their locations are leases. So they don't need as many capital expenditures. They really just have inventory that they want to turn over. So that's probably going to be the most important area, is looking at their inventory and their operations. As you can see here from their grade in operations, they've got a C- there. And I think that's where investors should be a little bit more cautious, be a little bit more in tune to their operations and the efficiencies in there. If they're not efficient within their operations, we're going to have struggles on the other areas. Clearly, they're doing really well with their margins and making up for it in that area. But it'd be really nice to see if they could improve their operations a bit more. I think this is a good segue to jump over to their 3 different segments that they have in terms of operations. We can see they have the direct-to-consumer, commercial, and international franchising. As you can see by their net sales up at the top here, clearly direct-to-consumer is the major producer here. But it has the thinnest margins. Their income, at least if we're looking at from income before income taxes, that's about 8% of their total net sales. When we look at the commercial division, 561 is the income before income taxes, and that's about 20% margin. The international franchising, they have 335, and that's about 40% of their net sales for the franchising. So I think there's really a huge opportunity, and it looks like the company's been taking advantage of the commercial and international franchising opportunities. I'm not sold 100% on the franchising as much, although I can understand how it would have a good benefit, especially if they're getting some good licensing agreements on the commercial end with certain companies that are international. But for a company that's so small, I like to see them focused more within one area, really get the operation set, have the company working like a well-oiled machine, be very profitable. And I think if you're working in different areas, you have a lot of different things to consider, like what's the exchange rates in all these countries? Does it, do interest rates affect something in the U.S. versus overseas versus Asia? So I think there's a lot more risk to be considered on an international level. So I guess I don't care as much about the international franchising as much. And maybe there's something I don't understand about their business model, which is quite possible. But what I'm most excited about is this commercial deal, their commercial licensing. Build-A-Bear's partnered up with Disney, Universal. If we take a peek at their product line, I mean, they've got Pokemon here. I don't know if this is any type of franchise. You know, Disney, they've got Star Wars. Scrolling down here, Harry Potter. Who doesn't love Harry Potter? Give me a break. So they've got multiple licensing deals, which I think is really, really cool. And I think if they can, right on the coattails of some of these larger companies, or create some synergies with the larger companies that have a great brand, right on their coattails, and sell their product. I mean, it's a win-win. So I'm more interested in that opportunity within the commercial licensing deals. I think that's huge. And the profit margins, I mean, the margins in that area are just really good. But it's really their operations that's just inconsistent, and that's where there's going to be more risk. So if you guys are okay handling some of the market movement, some of the operational risks that management is facing, then yeah, maybe this is a stock for you. If you're looking for more comfort, more safety, security, something consistent that you can go to bed just knowing that this stock is going to be performing the right way, I wouldn't lean towards this one. I'd just pass this one by. But seeing that they had a 300% return last year is just unbelievable. And I don't believe in chasing returns, but I believe in following fundamentals. And based on what I'm seeing, there's opportunity for them to make some improvements. They have some really good licensing deals that I think they can continue to build upon. I mean, again, we're talking about Disney, Universal, Harry Potter, Star Wars. Like, all the kids love that. Even grown-ups love that. You know they're going to do that. And I'll tell you just from personal experience, when I jumped on their website, they do a good job at whoever's doing their marketing or their analytics for the marketing is killing it, because their ad popped up about 6 times yesterday on my phone as I'm scrolling through Facebook or Instagram. And it wasn't annoying. They do it in a way where the ads are changing. They're more subtle. They're not spamming the heck out of you. And it made me realize, you know what? They're doing a good job with some of their analytics. And so, hey, if they're having any troubles, maybe operationally, or they're having some issues with people getting into the stores and purchasing their product, looks like they're doing a good job online, at least in terms of their marketing. So some good opportunities there. So based on seeing the solid margins, the opportunity for them to make some corrections and drive more profits that way, I'm okay taking that risk. Again, I know there's going to be volatility. It's got a high beta, which, you know, we got to go for the ride. I think it could be a good stock to invest in. If you found any value out of this video, please be sure to like and subscribe to the channel. And if you want to join in any conversations, jump on Facebook, go to the Market Interest on Facebook and join the conversation. And if you guys have any suggestions in terms of future stocks or companies to analyze, then, you know, shoot over a message or jump on Facebook, let me know, and I will be sure to break it down in the near future. All right. Look forward to seeing you guys soon.